Okay students, this is the third video and the last video for Chapter 1 for Principles of Financial Accounting. In this video we're going to talk about the three basic financial statements that are covered in this chapter, and that is the income statement, the statement of owner's equity, and the balance sheet. The statement of cash flows is not covered in this chapter in detail, but will be covered in a later chapter. All of the financial statements have a three-line heading, and the three-line heading is the name of the company, the name of the statement, and the date. And the date can either be for a period ended or it can be a specific point in time. We're going to start with the income statement. You always start with the income statement so you can get the net income and take it to the next statement. So the income statement covers a period of time. In this case it's going to be for the month ended January 31st, 2013. If you remember, we had photography fees collected. That was our revenue of $10,000, so we're going to put that in. Then we had expenses of rent, salary, supplies, and that totaled $4,000. The difference between those is our net income of $6,000. Okay, let me point out a few things about every financial statement. You need to capitalize the heading. You need to capitalize the first word of each of the account titles. And also you need to put a dollar mark at the beginning of each column, a dollar mark at the total, the end, and sometimes you'll also put a dollar mark for a subtotal, which we'll discuss a little later. You also put a single line before a subtotal or total and a double line after the total. Formatting is important for financial statements because in a lot of cases financial statements are given to companies and individuals outside of the company. So therefore it is important. And I am a little stricter on formatting for financial statements than I am in other areas, simply because it is important for that reason. Alright, now we have the $6,000 net income. We're going to take it over to the statement of owner's equity. The statement of owner's equity also covers a period in time, so it's for the month ended January 31st, 2013. We start with our capital beginning balance, and the capital account is always named for the sole proprietor. In this case it would be B. Fowler Capital, and you start with the first date of the period, which would be January the 1st. We started with zero, remember, because we added in an investment during that time. Okay, then we're going to add in the investment. I just made up the January 3rd. That's a good time to put it in. We put in $20,000. Then the next thing we're going to add is the net income. Now if you remember, we talked about capital being increased with revenue and decreased with expenses, but that's what we did over here, right? And we got a net of those two with our net income. So now we're going to add that net income in to our investments to show the things that we added to capital during this period. Now if we had a net loss, we would subtract it down here. We're going to add these two amounts together simply because we need an amount to subtract something from. This is simply a subtotal. It doesn't have a title. So we're going to subtract the withdrawals from the subtotal that we have, and we have less withdrawals here. So since we have less here, we don't have to put a minus mark here because we know this is going to be subtracted. When we subtract that, we get our increase in owner's equity. This could be a decrease, but in this case it's an increase. So we have $24,000 as an increase, add it to zero, and our ending capital balance as of January 31st is $24,000. Again, notice the dollar marks at the beginning of the columns. In this case we have a dollar mark here because this subtotal will have something subtracted from it. And then the single lines and the double lines before a subtotal or total, and the double lines after the total. Okay, now we're going to take that new capital amount to our balance sheet. The balance sheet, the date on that is as of a particular date because it does not cover a period. We're just taking our balances as of a particular point in time. So that's January 31st, or it could say as of January 31st, 2013. This is the account form of the balance sheet where you have assets on one side, liabilities and equity on the other side. Later on you will talk about the report form where you have the assets above and then the liabilities and owner's equity below. Over here you have your total assets. You got cash, equipment, and supplies. Total assets of $34,000. We took all of this information from the chart that we generated in the previous video. Over here we have liabilities. The only one we had was accounts payable. So that's $10,000. Then our owner's equity, we have the capital, and that was $24,000 that we take from the statement of owner's equity. Add those together, and we have total liabilities and owner's equity of $34,000. When these two amounts in the balance sheet are the same, you know that you've done the financial statements correctly. Because they must balance just like the accounting equation must balance, and you can see that the balance sheet is a reflection of the accounting equation. That's all for now, and I look forward to discussing this with you and answering any questions that you might have. Thank you.